everyone. It's Wes and Austin from Westwood again, and today we will be talking about ways in which an individual can reduce or avoid some of their exposure to income taxes by incorporating tax-deferred or tax-exempt accounts into their overall planning strategy. Specifically, we will briefly cover the basic types of tax-deferred savings plans and accounts, some recent changes to the laws that influence how we utilize these tax-advantaged accounts in our retirement planning, and a few things to keep in mind when incorporating these accounts into your financial and estate plans.
So if you consider a long enough timeline, every investment is assumed to provide some amount of monetary gain or return to the investor, right? But every investment comes with a variety of costs as well. These costs can be in the form of marketing fees, management fees, mutual fund loads, and/or broker commissions. But the most prevalent cost that probably sting the most is income taxes in the form of long-term capital gains, short-term capital gains, or ordinary income.
But there is some good news here, which is a savvy investor can incorporate a variety of tax efficiencies into their overall strategy and planning in order to reduce or avoid their potential income tax exposure and consequently increase their potential investment returns, which can be utilized particularly in the context of retirement planning. And these tax efficiencies are generally achieved by utilizing specific investment accounts and other assets that can be generally classified as tax deferred or tax exempt. Now, tax deferred accounts in general provide an upfront income tax break or deferral to the investor. That is, the investor may postpone, delay, or defer making income tax payments to the IRS until some later date. For example, let's say the investor's age of retirement.
Now, contrast that with the tax-exempt accounts, which can generally be income tax-free or tax-neutral to the investor. Some assets can even be classified as tax-efficient because they trigger fewer capital gains in the case of exchange-traded funds or ETFs, or because the interest income isn't taxable either at the federal or state and local levels, which is the case of municipal treasury and Series I savings bonds.
Now, we have provided some examples of just a few of the various tax advantage accounts and assets that are available to investors. And while we won't be exploring each and every one of these examples in detail today, the key thing to remember here is that the tax advantages provided with these accounts and these assets are obtained basically because of some kind of trade-off that must be made by the investor, which is to say that in exchange for reducing or avoiding income tax exposure, the investor must generally accept additional limitations or restrictions on these assets that are not typically found in other investment assets that don't also possess the same tax benefits that we'll be discussing here today.
Thanks, Austin. Let's now turn to an area where tax-deferred and tax-exempt accounts arise often, which is in the context of retirement planning. This is also an area that is governed by a complex and ever-evolving set of rules and laws that impact how we can access and obtain the tax benefits associated with these accounts. For today, we will focus on two basic retirement savings account types: individual retirement accounts or IRAs and 401ks. Each of these tax advantage accounts has different limits and rules, and each offer a traditional and Roth option.
IRAs and 401ks are basically specialized savings accounts that share a lot of the same concepts, but they're also uniquely different from each other in a lot of material ways. And we're going to be drawing comparisons between the two throughout the rest of today's discussion. But let's begin with an easy one and just compare how these accounts were created in the first place. So you, that is the investor, are going to be responsible for opening your own IRA, just like any other savings account. However, it's actually your employer who's responsible for opening a 401k for your benefit.
And additionally, IRAs and 401ks differ in how an investor makes deposits or contributions in this context. One of the trade-offs for receiving these tax advantages is that the investors are limited in how much they can contribute to these accounts on an annual basis. In 2022, the maximum contribution amount for all of an investor's IRAs is $6,000 or $7,000 if you are 50 or older. And for any given year, contributions to an IRA are allowed up until the mid-April tax filing deadline the following year.
And for 401ks in 2022, The maximum contribution amount for all of an individual investor's 401ks is $20,500 or $27,000 if you're 50 or older. But for any given year, contributions may be made into a 401k only up until December 31st of that year, unlike IRAs. However, an employer may offer to make additional contributions into an employee's 401k, which is referred to as matching. Any employer's match will be limited usually to some stated amount. For example, an employer might match up to 6% of an employee's total contributions to that 401k just for that year. But not all employers offer matching. And for the employers that do offer matching, they typically vary from employer to employer. But if an employer does offer matching of some kind, then the employee should take that opportunity to receive this additional compensation benefit into their 401k.
Let's now talk about how your contributions will be invested year over year. In general, you are responsible for selecting the investment options and strategies such as stocks, bonds, mutual funds, ETFs, etc., that will be applied to your IRA or 401k. But the investment options that are available for IRAs tend to be broader than the investment options for 401ks. This is because your employer first selects a 401k plan administrator who then provides employees with a limited menu of investment options to choose from. Keep in mind that these employee investment options will also vary from employer to employer.
So IRAs and 401ks can also be organized either as traditional or Roth accounts. And if you have the option and are eligible, you can choose one or a combination of these two types. And the primary difference between the two comes down to when you pay income taxes, that is, pay now or pay later, and then what you actually pay those income taxes on. So for traditional accounts, contributions are going to be made from your gross or your pre-tax income. So you get an upfront tax break today in the form of lower taxable income. But you will then pay taxes upon withdrawal later on for both the withdrawn contributions and any growth from those contributions. And hence, the tax advantage to traditional accounts is going to be tax deferral. But for Roth accounts, your contributions are made from your net income that has already been income taxed. So you get no tax break now, but you do not pay taxes in the future upon withdrawal, which means that the tax advantage to a Roth account is tax exemption.
Also, the contribution limits mentioned previously are cumulative and apply to an investor's traditional and Roth accounts, meaning your 2022 contribution limit of $6,000 can be split between a Roth IRA and a traditional IRA, but your total IRA contributions cannot exceed $6,000 or $20,500 in the case of 401ks. A few other key distinctions to note are not all 401k plans offer a Roth option. Eligibility for Roth IRAs is determined by an individual's income limit. That is, higher income earners may be phased out of the ability to contribute, and there's no income limits for Roth 401ks.
Thanks, Wes. So let's now turn to early withdrawals. And early withdrawals basically means the withdrawing of any money from these accounts we've been discussing before you turn 59 and a half. And these early withdrawals are going to be treated differently between traditional and Roth accounts, which is basically another trade-off that must be made by an investor in order to get some tax advantage here. With traditional accounts, early withdrawals incur a 10% penalty plus taxes on the entire amount withdrawn. But for Roth accounts, there is no penalty to withdraw contributions at any age because your contributions are made from your net income, and that's already been taxed. However, you may pay a 10% penalty plus taxes on any withdrawn earnings from those contributions, but that's subject to some specifically permitted exceptions, such as withdrawals for a first-time home purchase or making payments for college or tuition costs or some specific disability costs.
But once you turn 59 and a half, withdrawal penalties are eliminated and any withdrawals from traditional accounts will be taxed at ordinary income tax rates. For Roth accounts, withdrawals are tax exempt and do not count towards your taxable income. And beginning in April after the year you turn 72, required minimum distributions or RMDs must be considered, which are the minimum amounts that the IRS states that you must withdraw from your account each year.
And remember, traditional IRAs and 401ks hold funds that have not been taxed yet. So every RMD will be taxed as ordinary income each year, and there are severe penalties for not taking your RMDs. However, Roth IRAs have no RMDs, and while Roth 401ks do have RMDs, the distributions are going to be tax-free and will not increase your taxable income.
And speaking of taxable income, another item to keep in mind is that contributions to a traditional IRA may be tax deductible, which could decrease your annual taxable income. If you are not already covered by a retirement plan at work, then you are permitted to take a full deduction on your income tax return up to the amount of your contribution limit. However, the amount of your available deduction is impacted if either you or your spouse are covered by a retirement plan at work. And please note that this deduction is not available for contributions to Roth IRAs and Roth 401ks.
And in addition to the 401ks and the IRA concepts that we've been discussing, there's actually some other tax advantage retirement accounts that are available for specific employee groups. So there's going to be 403B plans, which are offered by public schools and certain tax exempt organizations, nonprofits, and cooperative hospital service organizations. Now, there's also 457 plans, which can be offered by state or local governments and certain non-governmental employers. There's also simplified employee pension IRAs or SEP IRAs. These are for self-employed individuals or small business owners. And then there's also simple IRAs, which stands for Savings Incentive Match Plan for Employees. And those may be set up by employers with less than 100 employees.
And before moving on, we want to reiterate the value in taking advantage of the tax deferral or exemptions we have been discussing.
Right. So by saving and investing in your available retirement accounts early and consistently, you will also be able to harness the power of compounding interest, which, when combined with deferring or exempting your income tax exposure, can lead to activating additional growth in the assets that you are setting aside for your retirement. With that in mind, let's now turn to some recent changes in the law that have impacted how these accounts are administered for the account owners, as well as the designated beneficiaries of each account.
So at the end of 2019, the Setting Every Community Up for Retirement Enhancement or SECURE Act was enacted. A provision in the SECURE Act effectively eliminated the stretch IRA in estate planning, which is an estate planning strategy that allowed an IRA to benefit from tax-deferred growth potentially for decades. Under the old rule prior to 2020, any non-spouse beneficiaries inheriting an IRA or 401k had the ability to calculate and receive their RMDs based on the non-spouse's life expectancy. And this ability to stretch or defer the new RMDs over that non-spouse's beneficiary lifetime was incredibly advantageous from a tax deferral and account growth standpoint.
So we want to spend a little bit of time considering a hypothetical just to highlight the difference between the old law and the new law. And the subject of our hypothetical case today is going to be an individual by the name of Scott. Now, Scott, under the old rule, he was 52 years old and he inherited a $1 million traditional IRA from his 85-year-old father. Now, under the old rule, Scott was basically able to stretch this traditional IRA by taking a new RMD that was set and calculated according to Scott's anticipated life expectancy of 32.3 years. And Scott only took the RMD each year from this account for the rest of his life. And by the way, he lived another 18 years and died at the ripe old age of 70. Before his death, Scott also named his 40-year-old daughter as his sole IRA beneficiary, who then continued or basically picked up where Scott left off and started taking her RMDs over the roughly 14 remaining years of Scott's anticipated life expectancy. All the while, the account continued growing, earning compound interest, and continued to defer any income tax payments on the funds in excess of those RMDs for many, many years. So, but that was the old rule. And as of January 2020, most non-spouse beneficiaries are now required to fully distribute their inherited IRAs and 401ks within 10 years of the owner's death, which means that any potential account growth, earned compound interest, and income tax deferral is also reduced to 10 years. And any funds not distributed by the 10-year deadline will be subject to a 50% penalty tax.
So under the new rules, Scott would have to empty the account within 10 years of his father's death, rather than enjoying the 32.3 years of tax deferral that was based on his life expectancy. And the accelerated distributions combined with Scott's other income could push him into the highest income tax bracket, which may not have been the case under the old rule. Therefore, the beneficiary of a traditional IRA might want to spread distributions equally over 10 years if possible in order to manage the annual tax liability. By contrast, the beneficiary of a Roth IRA, which generally provides tax-free distributions, like we discussed earlier, might want to leave the account intact for up to 10 years if possible for the potential benefit of tax-free growth.
Right. So now we're into the new law era of these distributions and administrations. And so let's focus on what we can expect to encounter in 2023. So for IRAs in 2023, the maximum contribution amount is going to now be $6,500 or $7,500 if you're 50 or older. And for 401ks, 403bs, and most 457 plans in 2023, the maximum contribution amount is going to be $22,500 or $30,000 if you're 50 or older. The SEP IRA contribution limit in 2023 is going to be the lesser of 25% of your compensation for that year, or $66,000. And the contribution limit in 2023 for simple IRAs is going to be $15,500 plus a $3,500 catch-up contribution for those age 50 and over.
Next, we want to delve into two commonly used topics around IRAs, which are conversions and rollovers, two separate and distinct acts used to solve two different objectives. First, let's discuss Roth conversions. And in general, you can transfer all or a portion of your traditional IRA funds to a Roth IRA. There are no income limits or restrictions based on your tax filing status. You generally must include the amount you convert in your gross income for the year of conversion, but any non-deductible contributions you've made to your traditional IRA won't be taxed when you convert. Now, here's why timing is important. The full amount converted is added to your gross income in the year of conversion. So good planning might involve converting traditional IRAs that have experienced steep declines in value with the intention of paying taxes now to potentially save in taxes later. Additionally, if you use non-IRA funds to pay the conversion tax, that results from, converting funds from a traditional IRA to a Roth IRA, the funds used to pay the taxes are removed from your taxable estate, potentially reducing your future estate tax liability. Additionally, the amount converted is not impeded by taxes.
And alternatively, the term rollover IRA generally refers to an IRA that you establish to receive funds from an employer retirement plan like 401k. Now, if you elect to create a rollover IRA, you must comply with federal rules that govern IRA rollovers. For example, the funds from a previous employer's 401k must be deposited or rolled over into the new rollover IRA within 60 days after receipt of the funds distributed from the old 401k account, or else be subject to tax consequences and penalties. But there's no limit on the number of rollovers from traditional IRAs to Roth IRAs that you can do in any given year. Now, the big picture here is, but in order to avoid any missteps, it is a best practice to request that the custodian of your former employer's 401k account make the transfer directly to the custodian of your newly established rollover IRA. And in light of the income tax deferral and exemption benefits that we've been discussing, these accounts and assets are going to usually be one of the most common and oftentimes some of the higher value assets that are going to be included in a decedent's estate. And while these assets are generally considered to be non-probate assets, meaning they pass according to a separate beneficiary designation document instead of under a will or a trust, Your will and your trust must nonetheless be diligently drafted to ensure that any potential estate taxes are properly apportioned in accordance with your wishes. Now, I realize that we've been spending a lot of time today focused on income taxation here, but these tax advantaged accounts are still includable in your estate for federal estate tax purposes. Consequently, your estate planning documents still need to be drafted to include provisions detailing the payment methodology for any estate taxes that are going to be owed based on the value of your tax deferred or exempt accounts, as well as making sure that authority has been given to your executor or your trustee or some other fiduciary to actually be able to recover from your designated beneficiaries that portion of your estate taxes that is owed to the IRS based on the value of your tax deferred or exempt accounts.
This also means that regular reviews of the titling of your current tax deferred and exempt accounts and the underlying beneficiary designations will be a critical step to ensuring that your estate plan can be carried out in a manner consistent with your final wishes.
And another planning item we wanted to touch on this time deals with lifetime planning, but investors can take advantage of utilizing something called a qualified charitable distribution or a QCD as an income tax-free way to transfer funds from your IRA to a qualified charity. However, there are a few rules that must be observed when making a QCD. First, only IRA owners who are age 70 and a half and over are eligible to even make a QCD. And second, QCDs can only be made from traditional IRAs, Roth IRAs, SEP IRAs, and simple IRAs that are not ongoing, which means a SEP or a simple plan that has received an employer contribution during the applicable calendar year in which a QCD would be made.
And last but not least, keep in mind that QCDs are capped at $100,000 per person per year. However, you may still take a charitable deduction for any donated amounts that exceed the $100,000 QCD limit if you itemize deductions and otherwise qualify for them. And finally, all QCDs must be transferred directly from the IRA to the charity. Prudent use of QCDs can be an advantage to those who are required to take distributions but might not need the distributions to fund lifestyle expenses.
All right. Thanks, Wes. So to wrap it up here, we've covered a lot of material in a short amount of time today, and we also managed to touch on several key takeaways about reducing and or avoiding exposure to income taxes, as well as some potential estate taxes. By incorporating these tax deferred or tax exempt accounts into your overall planning strategy.
Specifically, the basic types of tax deferred savings plans and accounts, some recent changes to the laws that influence how we utilize these tax advantage accounts in our retirement planning, and a few things to keep in mind when incorporating them into your financial and estate plans. While this wasn't an exhaustive conversation, our hope is that we have armed you with enough information to have an informed discussion with your respective advisors. As always, we appreciate your time and all our best.
Thanks, everybody.